Well, Dan Lacalle is with us, Chief Economist at Tressis Gestion. And as we look at the weakness on the overnight markets in Asia, Dan, there is, I think, an interesting line you have compared with the consensus at the moment, that you don't think emerging is a safe place to park money at the moment. Mm-hmm. Most investor surveys are coming back with a more positive attitude towards emerging markets. You don't agree?
The reason why I don't agree is because you have the first signals again of weakness in emerging currencies. The Argentine peso, the Turkish lira, the Indian rupee are already showing a level of weakness that is quite a concern, particularly when the Fed policy is of easing, when the Fed policy is of maintaining low rates, and at the same time when the dollar is not moving, the DXY index. So that's the first signal to be concerned about. The second is commodities. Commodities have risen with liquidity and with global money supply growth. That is fine. However, the macro data, supply and demand fundamentals are showing the same level of weakness that we were thinking about at the end of last year, if anything, a little bit worse. Therefore, you need to be aware at least of the fact that both on the currency side and on the commodity side, probably the tailwind is behind you. And the third one is the level of extreme complacency with debt. That is fine right now, but money supply growth has virtually stopped growing since February. So if you see money supply growth at a global level stop growing since February, you at least have in the next 3 to 4 months some warning signs ahead of you in terms of the real GDP growth that is going to come up. So I think you need to be a little bit cautious, simply because most of what you could as a fundamental investor expect out of emerging markets for 2019 has already happened. That's it. That is simply it, is that you have it, you bank it and you move on to safer territory, in my opinion.
If you are chasing growth, then it's not going to come from these so-called fast-growing markets in Asia or parts of Europe or Latin America. Where would you turn focus? Is it, that usual suspect, technology?
Technology is it, but it is it, because you cannot expect that what everybody is seeing, which is disinflationary pressures. You're seeing some slowdown in the major economies, and at the same time, the overcapacity being perpetuated by very low rates and very high debt. You cannot expect the traditional drivers of growth to help you in your investment case. So commodities, headline inflation, etc. Where are you going to see the growth? The growth is in disruptive technologies. That is where you have real, sustainable, and actually fundamental growth.
Even from current levels, though, Dan? Because if you look at the NASDAQ, it's close to a 6-month high. So isn't some of this already priced in, where investors have gone stampeding into growth stocks like tech?
Yeah, but let's talk the concept of being priced in, because yes, obviously the NASDAQ is expensive. Obviously technology is expensive. Relative to what? Relative to a zero interest rate environment? Relative to $11 trillion of negative yielding bonds? Relative to 17 countries with the yield curve inverted? Therefore, in reality, it is not that expensive. And again, compared to value traps. So what we need to be aware is that, yes, those multiples are maybe high, but they're high for a reason. And we need to be, as always, extremely aware of multiples that are low, but low for a reason as well.
Dan, thank you very much for honing our focus on growth at this point. Let's push on.